Okay, thank you for joining us for today's Learning Table. Welcome to our tax planning webinar presented as a joint project by WiseOwl Legal Practice Management Software and Cascade Accounting and Tax. Today, our presenters are Karen McDonald and Elizabeth James. Karen is an accountant, tax agent, and technologist, founder of Cascade Accounting and Tax and WiseOwl Legal. Karen started her career in public accounting and then had experience in large corporates, government, before returning to her passion of small business. Cascade was founded in 1998, supporting small business in the accounting system space, and then later focusing on law firms. It became a full service accounting and tax practice in 2013. WiseOwl Legal was born in 2011 after many challenges from law firm clients to write a practice management program for law firms. WiseOwl Legal has been helping law firms save time and money since 2016. Karen is also a member of the Australian Computer Society and an associate member of the Queensland Law Society. So welcome, Karen. And we also have Elizabeth. Elizabeth is an accountant and tax agent in her own right. Elizabeth has been working half-time for Cascade since 2022. She has an in-depth knowledge of taxation law and has spent time lecturing in tax law at Griffith University. She has run her own accounting and tax practice for 30 years, and Elizabeth brings a depth of knowledge and experience to Cascade and is an invaluable member of the team. So welcome, Elizabeth.
Hello.
Wonderful. So just a bit of housekeeping. If we do notice noise behind people, we'll mute them. But apart from that, feel free to put questions in the chat box and we'll answer them as we go along. I'll pass off to Karen.
Well, thank you. And thank you for joining us. I hope that today is going to have some new learning for each of us. And yeah, we'll just get started. So, tax planning. What is it about? We're looking to maximize deductions, minimize surprises, and to grow our wealth. But about me, I have been working in the tax space since I left school. I'm known by many people as someone who gets things done, and let's get on with it. So today's agenda is to look at the benefits of tax planning, the mechanics of tax, the business tax strategies, superannuation planning, personal tax opportunities, common pitfalls to avoid, and we'll answer some questions and then offer you a checklist that we can send to you after the session. As you can tell, I really like this slide. Nothing is certain except death and taxes, a very famous quote. So the benefits of tax planning: to plan prior to the 30th of June so we can reduce stress later. We're focusing today on Australian SMEs. What is an SME? It's an organisation carrying on business, and that's as opposed to a passive income. So the tax treatment of a business is different to somebody that just has passive investments such as shares or real estate investments. And an SME has turnover of under 10 million.
And SME stands for small and medium enterprise. It's an ATO, a tax office.
Yes,
convention.
acronym.
Acronym, yeah.
Proactive tax planning can reduce tax payable, improve our cash flow, and identify some deductions we might otherwise miss, and also help us to avoid some of the ATO red flags. So let's make sure you don't leave money on the table and that you can get the best benefit out of your tax planning. Timing is everything. So if we consider we've got large expenses or expansion coming, we can use some clever tax planning to take advantage of that. The ATO has legislated the $20,000 instant asset write-off, so we can be comfortable in knowing that that is available moving forward. So if you need to upgrade your IT systems, your coffee machines, your office furniture, other equipment, just do it now. Another thing to be considered in tax planning is your exit strategies and your changes in personal circumstances, such as when you're having kids, when they're going to high school, when you're retiring, if you're moving, or if you're having a year off to travel. So the purpose of tax planning is to align our tax plans with our 3 to 5 year business goals. So we're looking way more than just saving tax. I'm a big believer that there's no benefit in spending money just to get a tax deduction. You really need to have a use for that item to justify going and buying it. Yes, if we really want a new car and we can justify a high business percentage, certainly if it's on our bucket list to get that new car, that's great, buy it before the end of the year. But if you're just trying to beat the tax man, we need to bear in mind that we do need to actually part with the money before we get the tax deduction, and we only get a portion of that spend back in tax saved. So some of the other things to consider is income splitting within the family group and when we plan to retire. So we'll talk quite a lot about the family group as we move forward. So by planning several years in advance for retirement, we can make sure that we're lined up for the small business capital gains tax exemption, because there's requirements to be met, such as our net assets need to be less than 6 million, and we need to have been in business for 15 years in some situations. Other situations, if we're of a certain age, we can just retire. But talking with your accountant about all of these on your personal circumstances is well worthwhile way before it's retirement time. One of the important things to look at is my business structure the most appropriate. If we are trading as a sole trader, it can be difficult to share income amongst the family. The other interesting thing about not trading as a sole trader is if something happens to the sole trader, then the business is immediately at an end. Whereas if you're trading in a trust or a company and something does happen to the key person, it is easy to just change the directors and the business can continue. So it really depends on what sort of business you've got as to what the structure is and your family circumstance. Again, that is information that you need to discuss one-on-one, particularly for your situation. So getting down to the nitty-gritty, the tax rates, they really make a big difference. Currently, company tax, if you're carrying on a business, is 25%. If you've got a passive income in a company, then the tax rate is 30%. The individual tax rates up until 18,200 is tax exempt, and then 18,200 to 45,000 is taxed at 16% plus Medicare. The next bracket from 45,000 to 135,000 is 16% plus the 2% Medicare. So that's a big jump of 14% there. So oftentimes we want to try and get some family members' income to be at either the 45,000 level or the 135,000 level so that they don't creep into that next bracket. Income from 135,000 to 190,000 is taxed at 37%. And of course, over the 190,000, it's 45%, plus Medicare, of course. So we really want to keep our income under the 190,000 because nobody wants to give nearly 50% of their income to the tax man. We also need to bear in mind that if we don't have health insurance, we're a high income earner, we get the Medicare surcharge, which is quite painful and expensive. And so that's over 97,000 for single and over 194,000 for the couple. Many people get caught out when they do hit the 194,000 family income where they lose their health insurance rebates. That can be quite a sting. And so once you're starting to earn good money, you need to tell your health insurance company so they can stop deducting those rebates from your premiums each month. So the mechanics of tax, the points where the tax rates change, which we've just highlighted, are really important, and the individual versus the company rate. So if you've got a business that is producing a good cash flow, then having that in a company means that you can have the tax, the income taxed at 25% as long as you leave that money in the company. The way a company is set up is it is the assumption that eventually the income of the company will land in the hands of an individual. And so and that passes out of the company by either wages or dividends. When you pay a dividend out of a company, if you've paid tax in the past, then that tax that the company has paid is held in the company as franking credits. And so you can then pass dividends out with the franking credits. And so when you're paying the tax in the individual's name, you're not having to pay that franking credit again because you're given a deduction for what's already been paid by the company. That all sounds a bit complicated, but it's something that we can work through with you and help you understand if you need more information about that.
And we keep track of every company's franking credits as we go. So you don't have to worry about keeping track of it. We keep track of it in your tax.
It's part of the tax return. Yeah. So in our tax software, we have a historical list of the franking credits that each company has. Okay, so the tax increments, which is what we've talked about, is where each of those gaps change. By being aware of these increments and using your timing cleverly, you can save some significant amounts of money. For example, if you've got a child that's turning 18 next year, then the year they turn 18, you can give them some substantial amounts of income and share that more evenly over the family. If you know that you're going to have a drop in your income in a year or two, then you can pass dividends out of your company in that year where your other income has dropped. And by doing that, you'll pay less money on that income coming out of your company. So once you start paying income tax on business income, if it's not coming to you by way of wages, then the taxman gets excited when you've got a tax bill at the end of the year. And so what happens is if you lodge a tax return and you've got income in the 23 year of 230,000, that tax is payable the following May. So the taxman gets excited and says, oh, 2023, you've earned enough money to pay $57,500 in tax. So we're going to assume that you're going to earn that exact amount next year, except we're going to increase it by 6% now. And so we're going to want that to cover the tax for the year 2, which in this example is 23-24. But the gotcha on that is that year 1, we've had the luxury of not paying any tax, or it could be misfortune, because we get to almost the end of year 2 and we've got to pay year 1 tax, and then 2 months later we've got to pay what the taxman estimates is going to be year 2 tax. And then when we lodge year 2's income, another 12 months later, we get credit for that. So that's how the PAYG instalment system works. Once a taxman knows you've earned a certain amount of money in an entity, he assumes that that's going to be what you're going to earn forever. And now that he's got this return lodged for year 1 at the end of year 2, right through year 3, he's going to have a quarter of that amount. A quarter of that amount each quarter. And so once you get past this year 2 business, it does smooth out because you're paying it quarterly. And if you have a big jump in income, then you just pay the extra tax on that jump. But if anyone wants a copy of this diagram, do let me know. I actually think it's probably up on one of my websites, but we can email it to you anyway. And so here is what the paying tax 2 years at once, which we've just looked at. So it can be a real trap. One of the statistics that's well known is that many businesses go broke at the end of year 2, and this is exactly why. So if you or your clients are new in business, do really encourage them to keep aside their estimated tax all through year 1 and all through year 2, so at the end of year 2, they don't go belly up.
Yeah, a lot of them also want to know what percentage to keep back, and it's pretty safe to go with like 20%. Keep that back for tax.
Correct. So the timing is everything. You can have a big delay in paying your tax just by whether you receipt it in June or July. So basically, if we have a choice of when we receipt income, delaying it into the next financial year is useful. If we have a choice where we're paying our expenses, paying them in June is beneficial because we get the tax deduction. So clearly, the timing is really important. Whether we prepay expenses will depend on our expected income. You know, if we're having a great year, then certainly delay the payment, the receiving of income, and delay the payment of expenses. But, you know, we really need to keep watching what that bottom line is looking like. And by looking at this year, next year, and the year after, and getting all that timing right means that we can manage what's going on in our business so that we're keeping our income as much as possible out of that 47% tax bracket. Some of the other things to bear in mind is your capital gains. If you do sell something and it's a capital gain event, don't get trapped. The capital gain is based on the contract price. So if you sign a contract in June and settle in September, that income belongs to the previous year. It can't be delayed. So oftentimes, if people are selling a business near the end, a capital gain, an asset that's going to attract capital gains tax near the end of the year, it is often worth delaying signing the contract till the 1st of July.
So just to clarify on that one, you've said the contract date. Is that the date they sign it or the date on the contract itself?
The contract is always dated as the date the last person will sign.
Perfect.
So this is just the calculation when we delay income. So if we have income come in on the 25th of June, 2025, the tax is due on the 15th of May, 2026. If a company, tax on 100,000 would be 25,000. If we had that income come into our books on the 5th of July, then we have another full 12 months before we have to pay that tax. So that is substantial. We get the use of that money for another 12 months.
Yeah, and all of us are in professional service firms, so we can invoice in 1 July if we want. And then if we're on a cash basis for GST, we can delay paying that as well into the next quarter instead of the June quarter. So there's a few other little benefits as well.
So if this was the same calculation in the hands of an individual, the 100,000, 25th of June versus the 5th of July, so it would be $39,000 tax payable by the 15th of June 26, or 10 days later, if we receive it, then we get an extra 12 months to use that 39,000. And that's tax at 37% plus 2% Medicare. So some of the tax saving strategies, when we're a small enterprise, we can pay tax on a cash basis. I know there are some accountants around town that still pay on accruals, even for clients that are entitled to pay on a cash basis. My question is why? Why give the tax man the tax on money you haven't yet banked? It certainly does not make sense to me. Making the most of superannuation provisions is probably one of our most powerful tools, particularly for people that are coming up towards age 60. There's all sorts of interesting games that you can play with the tax man around superannuation. We've been talking a bit about tax saving by deferring of income, and we can also prepay many expenses for up to 12 months. And again, we can invest in equipment. So there are some of the small business concessions. And we're going to talk about superannuation in the next few minutes in quite some detail. Now, the first thing with superannuation is don't lose the deductions. I've seen many people pay super late over the years. The tax man has gotten really cranky, and he has been crankier than I've ever seen him before in the last 12 months. There's a lot of rules within the tax office and legislation that has been around for ages, but doesn't always get enacted. One of the things that some people have been able to get under the radar with is the superannuation deductions being paid late. Over the last 5 to 10 years, many people have paid their superannuation after the 28 days, after the end of the quarter, and it's gone under the radar. Not anymore. The taxman is really cracking down on getting those superannuation payments on payroll paid within 28 days after the end of the quarter. And the penalty is not only do you lose the deductions if you don't pay them on time, it's $25 per person per quarter in penalty, which is also not deductible. So that's for the employee. And then for management, each person can contribute up to $27,500 each year. Now, the nice thing is that that money comes off the top of your tax. So if you're earning $180,000 and paying 39 cents in the dollar, then you're getting a deduction of 39%. But when it goes into your fund, it's only taxed at 15%. So if you've got the cash resources or you're coming close to retirement, then making additional superannuation contributions certainly makes sense.
Sorry,
go on.
Aaron, just the cap. Yeah, this year it's gone up to 30,000. So
there you go.
More than 27.5 now. Yeah.
Okay. And after preservation age, even if you haven't retired, you are able to access some of that super tax-free. So it really is worth those few years, coming up to age 60 of maximizing your super contributions, because yes, after preservation age, what you take out is tax-free, and that really helps your cash flow immensely. Okay, so again, with super, we need to make sure that the employee super is paid well before the 30th of June. It has to actually be in the hands of the super fund before the 30th of June to be a deduction in the books of the business. And yeah, some of the things we need to be looking at are, what are my cash needs now? How long till retirement? Having these conversations with people that have got teenage kids all in high school is a waste of time, because they're spending all their money at the supermarket and on school fees. But when the kids have left uni, then these become a much better proposition for those sorts of people and makes a much better use of their cash at the time. So some of the checks we need to do with companies and trusts as we're doing our tax planning is to be aware of what the franking credits are in our company. Make sure we make good use of them. Review the directors' loans. If you've got a company and the directors have been pulling out cash without it going through dividends or wages, then you end up with a Division 7 loan. That is a big problem, because the taxman can deem that as an unfranked dividend. So if you've got money that you've already paid tax on in the company and you're deemed with an unfranked dividend, then that 25% of tax that could be a franking credit and a deduction in your personal tax is null and void if the taxman declares an unfranked dividend. So, and with discretionary trusts, we've had Bamford, and it's more important than ever to make sure that your discretionary trust minutes are all finalised before the 30th of June. The way that we do distributions through the family trusts now has tightened up, and we have to be a lot more careful that we're not seen to be just maximising how we distribute around the family, when that it really is our intention anyway. Okay, so any questions?
So if someone wants to make a decision about their tax planning for the current financial year that's ending in just over a month, when should they be making those decisions?
Like now? But really, it's important that you don't leave it till the last week of June, because if you need to have your financials brought up to date for tax planning purposes. If you come and see your accountant in the last week of June, and there's a dozen other people doing the same thing, there is a chance that you might not be able to have the best information for those decisions in time. So if you start working with your accountant in May, then your accountant can always make sure that they have a good estimate of what your income is going to look like and give you that best possible advice so that you're making the best decisions around how you move your money around in tax time to get the best benefit for your business and to add to your wealth in the best way. So just looking at personal tax planning, you've got work-related deductions, you've got your home office. Don't forget all the money you spend on professional development. If your employer pays it, then certainly that's already claimed in the business. But if you've paid for it yourself, then you're certainly entitled to claim that. Work-related travel, anything else that is particularly for work, subscriptions and things that aren't claimed already by your employer or in your business can be claimed personally. You need to review your shareholdings and the tax impact of that. If you've got shares that you're thinking about selling, then again, the timing is everything, because, if you've got big capital gains coming, capital gains go on top of your ordinary income. Yes, you get a 50% deduction, but if you're earning already over 190,000 and you have a 20,000 or 40,000 capital gain, that could be $20,000 that is taxed at 47%, which would be quite sad of giving that much money to the tax man when you've had that money tied up for all those years. Do make sure you declare all of your income. There are penalties for not declaring it. And most income does come through the tax agent's pre-fill report, but the pre-fill report is just courtesy and it's a help. It is not, if you've got income and it's not on the pre-fill report, it is still your responsibility to declare it. Do make sure that you claim all your donations, cost of your prior tax prep, and your income protection insurance. Most insurers give a statement at the end of the year, and that can be a substantial saving. So putting it all together, we need to be organised. We need to talk to your accountant about significant changes in your business. We need to plan our investments, and don't just spend money just for the tax deduction. You do have to earn it first. So some of the common pitfalls to avoid, we'll just recap on these because they are really important. Your employee super, that really does need to be paid by about the 25th of June. Your director's super, that's when you're paying extra so that you can get better benefits. Make sure your lodgements are on time. The taxman is getting more and more savage about on-time lodgements, on-time payments, so much so that he has announced that there won't be any tax deduction for interest on late payment of tax. You do need to be responsible for holding tax invoices for all of your expenses. When the most common audit we see is a GST audit. And when there's a GST audit, it generally is triggered if people have bought a new asset, such as a new car, that sent them into a refund. And then when they audit, the first question they ask is, give us the top 5 or give us the top 10 tax invoices in value for that quarter. And generally, you produce those, they're happy, and it goes away. But certainly if you can't produce tax invoices, then you will lose the deductions and the taxman will issue an amended assessment. Do make sure that you declare all subsidies and grants correctly. If you're getting an employment subsidy or if you're getting a government grant, the tax treatment on these are very, very different. Some have GST attached to them, some don't. Some are taxable, some aren't. So you need to keep your paperwork when you receive subsidies and grants, and you need to make sure that they are treated correctly for tax. Asset loans to directors, we've been talking about these already, the Division 7 loans. We need to make sure these are cleaned up. And if you do have a company with an asset loan, we need to make sure that there is a Division 7 loan in place. The taxman will give you 7 years to pay it off if it's unsecured, or 21 years if it's secured. The way that the asset loans are paid off is generally by declaring dividends that are non-cash, and they reduce those loans. So it is something we need to work, or any business owner with a Division 7 loan problem needs to work with their accountant and work through reducing them steadily. And oftentimes the interest on those Division 7 loans is not deductible unless it's been loaned to another business. The ATO penalties are not deductible. We want to stay out of that environment so we're not incurring them. And we also need to be careful if us or any of our clients have new businesses or growing businesses. It is up to the business owner to be responsible to register for GST when the turnover reaches 75,000. It is not the taxman's problem. And if you don't register for GST when you reach the 75,000 turnover, there can be some serious penalties in place. Any questions there? Okay, now the deadlines. The 30th of June is the obvious one. Directors' fees need to be documented. Employee payments must be physically paid prior to the 30th of June. But remember, you've got your single touch payroll, you've got your finalisation events run on the 30th of June. Last year, we had someone who paid their super around the 20th of June. We finished their event. We finished all their single touch payroll events, lodged everything, finalised for the year, and they were due to pay on the 1st of July was their next payday. Well, one particular lady got excited and decided that after we'd paid all the super and finalised everything off, she was going to process it on the 30th of June. Oh my goodness, that was not a fun mess to clean up. Certainly, we could have paid the wages on the 30th of June to increase our deductions, but that wasn't what was negotiated with the business owner. The business owner had just wanted to finish off his payroll on the same day as normal, because payroll was normally paid on a Monday. He wanted to keep that cycle happening, but he wanted to pay the super prior to the 30th of June, which is why we calculated the super and finalised everything so that he could get the benefits of that superannuation deduction. Asset purchases do need to be installed and ready for use by the 30th of June. Trust distributions, as we've been speaking about, must be documented and signed off. Superannuation contributions, yes, we're hammering on about this, but if they're not in the hands of super fund before the 30th of June, then the deduction goes into the following year. So we recommend that all superannuation be paid at least 5 days prior to the 30th of June. Depending which day of the week the 30th of June lands, it might even need to be a day or two more.
And just on the superannuation there, if it's personal contribution, not through your employer, there's extra forms that need to be filled out and sent to the super fund and then have to come back from the super fund as well. So that has to be done earlier again.
Thanks, Gemma. Okay, so some of the ATO gotchas. First up is the last 12 months, the taxman has his cranky pants on like I've never seen before. And it is certainly a policy thing, because it's not just 1 or 2 ATO staff having a bad day. It's a policy. It's very clearly a policy that's coming through, and the ATO staff are just implementing it. There's been a lot more trouble to get payment plans, a lot more fuss about a lot of simple things. And yeah, it really is a policy thing that's coming down from the government. And as we mentioned, the ATO interest deductions, ATO interest payments on late payments are no longer deductible from the 1st of July. One of the gotchas we've seen a few times has been HECS. And we've got the HECS table up here, and it's quite a trap, because if somebody gets a $5,000 bonus, that can put them from a 4% HECS level to 4.5. If they get two $5,000 bonuses, then that can move their HECS up by a whole percentage point. And that doesn't sound very much, but HECS is levied on your entire income. It doesn't step up like income tax. So if you are earning 95,000 and your income, and you have, if that's your total income with your bonus, but your income for the year without the bonus was 84,000, then you have an extra $10,000 of income, and that has put your HECS fee from 4% to 5%, which is an extra $1,000 to pay in HECS. Now, unfortunately, when the tax is withheld from your payroll, the way the tax rate's structured is that the taxman assumes that you are earning the same amount every pay the whole year. So what comes out of your bonus is higher for that pay only, but if you're moving from 4% HECS to 5% HECS, it's only on that bonus week that your extra money's coming out. So we have many people who have ended up in this HECS gotcha of having to pay a whole 1 or 2% more because they've had some bonuses, which means their pay through the year isn't even. And if you're paying bonuses to your staff, it really is useful to keep that in mind and then look at their year-to-date earnings so that they don't get a nasty tax bill at year end. We've seen a couple of people get tax bills of a couple of $1,000s because they've done really well on their bonus scheme, and they get all excited about spending their bonus only to find out that the taxman has his hand up for much more than they expected. We've got a blog article about the ATO and Christmas parties. And I've called the ATO the Christmas Grinch. I wrote this several years back, and it was quite funny. It went out on MailChimp as a December newsletter, and the tax office actually had a look at it multiple times, trying to find out if I was doing something wrong. I wasn't doing anything wrong. I was stating the fact that if you have a Christmas party, then you don't have to pay fringe benefits tax on that Christmas party if it's under $300 per person. But by the same token, that Christmas party is technically not deductible. And I've got an article on that. You can either read it online or we can send it out to you if you want to have a read of it. But I had a bit of a giggle that the taxman kept having a good look at it and couldn't catch me on anything because I was just stating fact, but I did call him a Christmas Grinch. There is quite a lot of accounting blogs on karenmcdonald.online/blog/accounting. That will be moving next month to the Cascade website, where we're doing a new website, but certainly there's a lot of really good articles there that have been written over many years on various tax topics and accounting topics and just general business topics, including the phones that we run that are a lot more economical than a lot of the other phone providers out there. And we've got many law firm blog articles at the Wisehour Legal website, wisehourlegal.blog, and they're on many, many topics on running a profitable law firm, and many people are finding them quite interesting and worthwhile. Okay, now have we got some questions?
Just on the HECS brackets, Karen, if someone is going to receive a bonus and they know that that could push them into the next HECS bracket, is there anything they can do, or, what would you recommend?
Just to be calculating your HECS. I'm just trying to stop sharing for a minute. Calculate your HECS year to date for your staff. Calculate your tax. So we can give you a calculator where you look at what the year to date income for that tax, for that employee is, and you can make sure that you're deducting enough tax. You can deduct extra tax.
Wonderful. And if anyone has any questions that they have about their personal circumstances that they want to discuss, how is it best to contact you about that?
You can send me an email, karen@cascadeconsulting.com.au, or alternatively, you can give me a call, 307 3422 1333.
I have a question about capital gains tax. Is it different for a person, company, and a trust in terms of?
Yes, capital gains tax in a company has no discount. So if you make 100,000 capital gains in a company, if that company is trading, so it has earned income, not just passive income, then the tax rate on the capital gain would be 25%. If the company was only earning passive income, investment income, then the tax would be taxed at 30% in the company. In a trust, you get the same discounts as you do for individuals. So you get the 50% discount, and then it goes on top of your income.
And if you can qualify for the small business CGT exemptions, there might be further discounts, but you need to meet the basic criteria first, which Karen mentioned early on in the talk, like the $6 million net asset. You have to meet that test. And there's a bunch of tests you have to pass before you can apply the provisions. But if you do pass the tests, then you can get like an extra active asset discount, which is another 50% discount. So if you're going to sell something significant, it's worth talking to Karen first to make sure that you meet the eligibility criteria first. And because if you don't, there are ways that you can make sure that you do fit the criteria.
If you've been in business over 15 years, then a lot of that is tax-free when you sell. But with bricks and mortar, buildings, all real estate, exemptions on that is really hard to get. We've actually recently had 2 different families who've come to us from other accountants, and for asset protection, they had their principal place of residence put into a trust, which sounds really great and clever. But when they sell it, there is no capital gains exemption for the first time for your principal place of residence. And it hurts, particularly with the rising real estate market. It hurts dramatically. So any other questions? Big smiles there, Duke.
Yeah. No, I enjoy the seminar. So I've learned a lot.
Have you? What's been your best learning?
I have to come and see you about the capital gains tax on the transfer.
That's all good. Well, we have a learning table every month, so stay tuned. Our next one is on the 26th of June, and most of them we will have special guests. If you've got any topics you'd like us to discuss, all pertinent to lawyers, do let us know. And we did have quite a few people enroll for this session today, so I'm quite sure that there'll be quite a few of those people watching the replay. So thank you, everybody.
Great, thank you.
Thank you.
Thanks, Karen. Wonderful presentation there.
Yeah, thanks, Karen.